And in fact, let's get rolling. So I'm Dave Yeske. I'm a managing director at Yeske Buoy, and I am sitting here with Lauren Stansel, who is our chief planning officer, and Yusuf Abujaderi, who is our chief investment officer, and who are also partners of the firm. And let me just welcome you and say that we are really, really looking forward to our conversation this morning. As I said a moment ago, we really hope that it's interactive. We have a lot to share, but we hope that you will feel free to share your questions in the chat, and we'll get to, as Lauren just said, as many as we can, and we'll make sure that anything we don't get to now, we will follow up. So Yusuf, take it away.
Get started. Thank you, Dave. So today's agenda, posted up here on the screen, we'll be covering several topics. We'll do a review of market performance last year. We are going to make some comments about valuations and why they still matter as it pertains to stocks. We'll talk about inflation because it's still dominating headlines. We're going to look at how markets have performed thus far in 2025. We're almost through January. We'll have some comments about things we're keeping our eyes on in terms of the road ahead for the rest of the year. And then we'll pivot away from market and economy-focused comments, and we'll do some discussion about financial planning considerations, some rules changes that we feel that our audience needs to be aware of, and a couple of notes on tax filing season because it's already that time of year. But before we dive in, as we like to do during these webinars, we want to do a quick poll just to check in with the audience. So how are you feeling? If you all would be so kind as to share with us your current state, that will help us gain a sense of where you are so we can meet you there as we go through our presentation today.
Okay, we've got lots of answers coming in here across the board. I'll give it another few seconds for a few final people to chime in and vote, and then I will share the results so everyone can see. All right.
So a mix. Some of you anxious, some nervous, several of you feeling calm or optimistic, and some of you not quite sure. And we will check in at the end of this presentation just to see if we've moved the needle at all by way of the comments that we've made today. Well, let's dive in. And as we start to talk about 2024 market performance, we can't do it without talking about the Magnificent Seven. If you're not familiar with this term as it pertains to stocks, not the old Western, the Magnificent Seven are seven
Actually,
of the biggest...
Yusuf, I have to correct you.
By all means, please.
The original was the Seven Samurai. The Magnificent Seven was a remake. So let's just be clear.
I didn't know. Forgive me. This Magnificent Seven pertains to $7 trillion sized companies. Each of them, the smallest of them, is still worth over $1 trillion. The biggest at over $3 trillion. Those 7 companies are in the S&P 500, and their weighted average return amongst the 7 in 2024 was 48%. So those companies on average grew by that amount, 48% in 2024. The rest of the 500 companies in the S&P 500, not pejoratively named the S&P 493, but the rest, earned a tidy 15.9%. Nothing to sneeze at, but it pales in comparison to what these 7 companies were able to pull off in 2024.
And I'll just jump in to say, Yusuf, you said they grew by that much. And because we're going to talk about the importance of valuation, I should say their price went up by that much. It doesn't mean anything fundamental like earnings and profits actually grew by that much, but their price went up by that much. We'll
Yes,
talk more about
yes,
that obviously as we go.
absolutely. And that's a critical note to make. Thank you, Dave, because that's going to set up some of the points that we're going to make later on through the presentation quite well. Before we go to our next slide, however, we have another poll because we wanted to test our audience and ask you, given what you may now know about the Magnificent Seven, what percentage of the S&P 500 do you think these 7 companies make up? Multiple choice. Answers coming in. And I hate to break it to you, but most of you are wrong. So the correct percentage, these 7 companies comprise a third of the index, 33%. So again, the name of the game, concentration. Anytime you have 7 companies taking up a third of the space in a 500 company set, I think you can say with accuracy that you've achieved a level of concentration that's significant, notable, and needs to be discussed. When we look at returns for the various asset classes in our Yesky Buoy stock portfolio, all of them listed here in this chart that we're showing you, you can see the S&P 500 dominated, and the effect of the Magnificent Seven being illustrated by kind of this extended tail, this particular bar at the top. If you'll recall, again, the 493 other companies had returns of about 16% on average. That would be about here. And then the other 7 companies accounting for this part of the overall 25% return. And look, it was a great year in markets across the board. Everything was up in 2024. Our portfolio of stocks was up just shy of 10%. You can see some trends here. U.S. stocks dominated. International stocks also turning in positive returns, but nothing kept up with the S&P 500 in 2024. So you might then wonder, why not just invest in the S&P? Why not just invest in tech stocks, which presently are eating up 40% of the index? Well, you're looking at what we like to call a periodic table of returns because it kind of resembles a periodic table of elements. And you're looking at a 34-year stretch of time. So from the beginning of 1990 through the end of last year, multiple colors here, each representing a different asset class, the S&P 500 in this dark gray.
And it's obvious, but each column representing half of a decade, 5 years.
Yes, exactly. And so when we look at performance for the S&P, we can see, you might remember the late 90s. It dominated the headlines and it dominated in terms of performance for that 5-year period. Average annualized returns of 28, almost 29%. You may also, however, remember the lost decade. So for 10 years, the same index that had been returning nearly 30% averaged an annual return of negative 1% per year for a decade. Whereas the rest of the asset classes that are illustrated on this sheet, small companies, large value companies, so not captured in the S&P 500, which is more skewed towards growth or more expensive stocks. All the other asset classes outperformed effectively across the board for that decade. Then we'll focus on the most recent decade, where the S&P has been dominating again. Not by the same margin, by the way, or not at the same scale, I should say. I mean, the returns are great. But even with a couple periods of relative dominance, what we wanted to point out is over the course of the entire period, the 500 companies that are tracked in this particular index, their performance was middle of the pack. not bad. Average annual returns or 5-year averages of 10.6%, fabulous. Better returns seen by small company stocks and small value stocks here at the top. Emerging markets too, by the way, outperforming the S&P 500 over this period. And we should note that Yesky Buoy's performance, we track back to 94. So effectively most of the sheet that you're seeing here kind of overlapping with our portfolio's performance over the past several years, past 3 decades, I should say. And for our viewers who have not heard us emphasize this in the past, our portfolio is in fact tilted in favor of small company stocks and value stocks relative to their weightings in the global market. So, there's a reason why we say you must diversify. Something is going to be at the top of the heap every year, every 5 years, every decade. But the likelihood of it being the same thing year after year or decade after decade, unlikely.
I'll just jump. Oh, sorry.
No, I was just going to say it pays to diversify. Please, Dave.
Yeah, and I'll just jump in. I'm old enough. I lived through all of this. I actually started practicing financial planning in 1990 at the beginning of this chart, 35 years ago. And we've always been investing the same way. We've always been investing in a way that we felt was grounded in the best available economic evidence. And that evidence points us towards buying stocks at low valuations, buying value stocks, buying small company stocks. And we were doing the same thing in the 90s and in the first part of the 2000s and in the most recent part of the 2000s. And so I will tell you that back in the latter half of the 90s, during the dot-com boom, when technology was taking off like a rocket, our portfolio was not doing as well as Intel and Cisco and all of the high-flying tech stocks. But during that after the dot-com meltdown in 2000, it was followed by what Yusuf just referred to as the lost decade. And many of you may remember at the beginning of 2010, the headlines everywhere were literally using that term, the lost decade, because the S&P 500 had not advanced at all between the beginning of 2000 and the beginning of 2010. But our portfolios had, and it was because all those other things, small company stocks, value stocks, international stocks, had all had nice returns during that period. So this is one of those cases where, if you're not swinging for the fences, if you're not making big bets on one segment like technology or blue chip growth stocks in the US, you're not going to do as well during the boom times, and you will do much better during the bust times. And I've been saying to my colleagues for the last few years that it's been feeling like the end, sort of the late stage of the 90s, the late stage of the dot-com boom, because we saw back then, technology only represented about 7% of the S&P 500 at the beginning of the 90s. And it had grown to represent more than a third by the end of the 90s, because the S&P 500 is what's known as a market-weighted index. So if the price of one segment goes up disproportionately, it starts to represent a larger and larger share of the index, as it has today. After 2000, it became, it fell back to about 13%, where it hovered for many years. And now, as you've heard, it's come back, and it's, on any given day, it's somewhere between 30 and 40% of the index. By relating this story, am I suggesting that we're about to see a return or a repeat of that experience? I don't know. Those of you who have been with us for a while know that we don't make predictions, not short-term predictions anyway. But we do think that value matters. And so when something gets really expensive, it got there for a reason. It got there because the prices went up a lot. But that's always a warning sign when you're looking forward. We can never look back because we don't have a working time machine. But if we're looking forward, we always want to be buying something at a reasonable price. And right now, that's not the Magnificent Seven. And I'll shut up there and let you carry on.
Please, Dave. It's a perfect segue. So you mentioned, valuations getting really high at the end of the 90s. We have that period on this particular chart circled here. US stocks, indicated by the dark blue line, got really expensive, mostly because of the run-up that was happening specifically in the technology sector. You can see the lines here for international markets, developed countries, indicated by the yellow line, emerging markets by the teal line. You know, their valuations or their measure of how expensive those particular stocks are have kind of hovered around the same place for the last 30, 35 years. Whereas you can see US stocks have bumped up and down, and over the past many years since the end of the Great Recession have been on the rise, but you can see the slope really got aggressive here in 2018 and 2019. We had the COVID crash, and then stocks have been getting really expensive really quickly in the US over the past couple of years. And, you know, as we're highlighting here, this is the most expensive they've been since the period, Dave, that you were referring to just a moment ago in the late 90s. And so we just make note of that. And when we're thinking about how to invest our clients' money, we can't not pay attention to the fact that US stocks are as expensive as they've ever been, and international stocks aren't. And so we make our decisions with the portfolio accordingly.
I mean, if you look at the economic evidence, it's been shown over many, many different time periods over the last 20 years, 50 years, 100 years. There are some economists who have actually reconstructed stock returns back more than 100 years. But the same thing repeats. Valuation matters. On a forward-looking basis, the best predictor of what your future returns are going to be is how much you pay now. And so if you can buy something cheaply now, all other things being equal, you can expect higher returns in the future. And this is part of the reason we have not been on the bandwagon. We do own the Magnificent Seven in your portfolio. It's just not all of your portfolio. And to the degree there's a tilt, as Yusuf mentioned a few minutes ago, to the degree there's a tilt, we're tilting towards small company and value stocks because we're always looking at buying earnings and profits more cheaply because we know, again, that's the best predictor of future returns.
And on that note, we'll give you another image here, just again, reiterating the point about how expensive, in particular, large growth stocks like those technology stocks that we've been talking about, like the Magnificent Seven, represented by the yellow line here, they're more expensive than they've ever been. If you look at that particular segment of the market, just focusing on large company growth stocks, this yellow line here, this is 100 years coming across your x-axis here, have never been more expensive, period, full stop. So given that, and given what we know about what valuations say about returns on a forward-looking basis, you know, we're looking at small company stocks, which are priced more cheaply. We're looking at value stocks, both large and small. And as we've always done, we're tilting the portfolio in favor of the stocks that are priced more attractively. Because again, on a forward-looking basis, that should help with performance.
And it's important to note, because when you look at a chart, you know, sometimes it's hard to interpret what you're seeing. This is not a chart of returns.
Right.
This is just a chart of how expensive different categories have become.
Right. Right. You have to pay more for what you're getting, the higher the line is on this chart. We're actually looking to pay less. We want more bang for your buck. So given all that, as we look forward now down the road in 2025, what lies ahead? Well, one of the things that we've talked about in our webinars over the past years, especially in the past several months, interest rates. Where are they now? Where are they headed? And it's interesting to note there's been a bit of a divergence in the trajectory of interest rates domestically versus abroad. So if we compare US interest rates, which are indicated by the blue line, the gray line here, we have the Bank of England here with the blue line. Now, interest rates right now are around 4.5% in the US and the UK. In Europe, however, they're quite a bit lower and on a trajectory perhaps through the rest of this year to come down maybe as low as 2% based on current projections. Why are we bringing this up? If you'll recall the prior slides, in terms of expensiveness, international developed markets, Europe taking up a large proportion of that, are priced cheaply. And in terms of the cost of capital, as defined by interest rates, the companies in Europe are able to access capital far more cheaply than the companies in the US and, well, I say Europe, but Europe ex-UK. That's important. We've made this note in prior webinars. Part of the reason the companies in the S&P 500, in particular the Magnificent Seven, have been able to have such fabulous performance is because over the past 10, 15 years, interest rates have been really low in the US. Comparatively now, they're looking like they're going to be a bit higher than they are elsewhere. And so that's interesting to note, and we thought we would bring it to your attention as we look forward down the road in 2025.
And
Please.
Well, and I'll just say, you implied this, but I'll just say explicitly, lower interest rates tend to favor growth stocks, and higher interest rates tend to favor value stocks. And so, if we're if we're in a regime where interest rates are not going to go back to zero the way they were after the Great Recession, and we don't believe they will, that's yet one more thing that would tend to favor small company and value stocks.
Yes, absolutely. The other piece, and this gets back to the valuation discussion, in terms of earnings growth for the Magnificent Seven relative to the rest of the companies in the S&P 500. We're looking at the past couple of years here down on the x-axis. The earnings growth of the Magnificent Seven since about the middle of 2022 is charted by this blue line. And you can see that that number is coming down pretty significantly, whereas the projected earnings growth for the rest of the index picking upward. And so we've got a couple of arrows here just to really, hammer the point home. That gap is bigger than that gap. And so with earnings growth projections for those 7 companies, those massive trillion-dollar companies, coming down to meet with the rest of the index, are we sitting here calling an end to the party? No. We're just showing you the information that's available to us and making note that things are different.
And the news of just the last week or so involving DeepSeek, which was the AI firm in China that seems to have broken some barriers in terms of producing a very effective AI without having to have a million high-end NVIDIA chips in its server farm. Now, we don't know everything, and we don't think that any information coming out of China is necessarily reliable, but it does at least hint at the fact that there may be innovations on the horizon that will allow AI, because we think AI is here. Artificial intelligence is going to be a factor in our lives from now on. And hopefully it'll be a good thing. We think it will be a good thing. It will aid productivity. It can be useful in so many different spheres. But it's kind of like the railroads. Railroad stocks were booming back in the 19th century when they were all being built out initially. But once they were all built out, they just became a commodity. They were just moving stuff for other industries around the country. And that was what happened in the late 90s, when you had companies that basically went broke, installing the fiber optic infrastructure that on which the internet runs today. And they were booming back then. And then they weren't. We still benefit from that fiber optic infrastructure, just as we will benefit from the advances in AI going forward. It just doesn't mean that the companies that developed it or the companies that are selling the chips on which it runs, like NVIDIA, are necessarily going to be the leaders going forward. They may just become the commodities that the railroad became in the 19th century.
And I'll close this segment, Dave, relating back to a point you made earlier in today's presentation and talking about stock price. You know, a company's stock price is just a representation of its expected future cash flows. So if earnings growth is taking a ride upward like this, you would tend to see it reflected in the stock price. And I think we made that point as far as how much the Magnificent Seven company's stock price grew last year, right? The 48% number that we shared. Well, projections are shifting. So how might that be reflected in the stock price going forward? Again, that's unknown and unknowable, but this is the information that we have available to us now. So sharing that with you because we thought it was of note. And with that, we'll pivot a bit to talk more about interest rates. As you may know, the Federal Reserve met yesterday and decided not to cut rates. So we're still right here, the red line here depicting interest rates, the federal funds rate, I should say, the baseline interest rate, still between 4.25% and 4.5%, unchanged. It will remain that way until at least March. Current projections are actually saying that it may remain that way through the middle of the year or through the end of the year, depending on some other things that we'll be talking about in just a few minutes. As it relates to that particular interest rate, inflation, you can see inflation peaked back in 2022. The Fed responded, raising interest rates, trying to slow down that price growth. And you can see the rates have come down considerably, although kind of sticking around 3%, 2.5%, 3%, the Fed's target being 2%. And so it's interesting to note that rates are remaining certainly higher than they've been in recent memory, and higher than expected. It was thought that we would have already seen several or even more cuts to this interest rate than we have in the past 6 months. And with guidance being that perhaps we won't be seeing many more cuts this year, it's shifting the way that we're thinking about things in terms of how markets might perform.
And this is one of those things that is, 9 times out of 10, when the Fed raises interest rates because it's worried about inflation, it sends the economy into a recession. It didn't happen this time. Now, you could say either that was because the Fed was extremely skillful in its timing, and to some degree that's true, but it's also a testament to how robust the US and world economies are right now. And this is one of those cases where interest rates are likely to, as Yusuf said, likely to remain somewhere near where they are now, in part because the US economy and the world economy is proving to be so robust. Even with a baseline of higher interest rates, it's still booming. We still have high employment, low unemployment, and significant, impressive economic growth. So this is one of those things where, the Fed is probably reacting to sound information when they say, no, we're not going to be in a big hurry to lower rates, because although inflation has come down quite a bit, the economy still looks really strong.
Yep. And we've got a few more images that we'll be showing you in the coming slides to back that up. But first, a quick reminder of how our portfolio performed throughout the rate hiking cycle in 2022 and 2023. You may remember that 2022 was no fun in the stock market. 23 was much more fun. And yet over the 2-year period, we're showing you here total return, not average annual return. This is total return for each of these asset classes over that 2-year period when rates were rising to combat inflation. The number one takeaway here being, and this is not to beat up on the S&P 500, but we do get this question all the time. Our portfolio just so happened to outperform the S&P. Why? Because our portfolio carries more than just U.S. large company stocks. And it were those particular asset classes that did quite well over this 2-year period. Here's the S&P. Here's emerging markets. So companies in India and China and scattered throughout Asia and Africa as well. Those emerging markets countries and the companies therein did quite well. Value stocks in the US, both large and small, did well, as did international value stocks. And Dave, you made this point just a moment ago. Value stocks tend to do better when rates are elevated. And our portfolio is one that's tilted in favor of value stocks, or stocks that are priced more attractively or more cheaply than their more expensive counterparts. Now, why do we remind you of how our portfolio performed when interest rates were rising? Because in the present environment where the guidance has shifted and the Fed is indicating that rates may be remaining higher for longer, we're seeing similar trends. So this is January through yesterday. You'll notice that all of the top performing stocks, or top performing asset classes, excuse me, I should say, in our portfolio, happen to have the word value in the title. It's just true.
And of course, you know that we don't.
Go ahead.
I was just going to say, we draw very few conclusions based on a single month's performance.
Of course. Right.
But when you're looking forward, it's okay to think about trends. And as we move into the new year, and as Yusuf said, with the interest rate guidance being what it is, we think that the first month of the year is reflecting that. And so is that going to continue? I mean, economically, the economic drivers suggest that it could or will. So anyway, I'm sorry, I shouldn't have interrupted there, but.
No, not at all. Not at all. That's perfect. And just pointing out, because we've been talking about the S&P, turning in a positive return thus far in 2025, and yet outpaced, again, by the rest of these asset classes that we've named, even international large company stocks overall, including international large growth stocks, doing better than the S&P 500 right now. So interesting to note. We'll see how the rest of the year unfolds. And some of the things we'll be watching will include news about things like tariffs. Why are we talking to you about tariffs? Well, first and foremost, because everyone else is. So what is this chart saying? It's using AI to track the number of times the word tariff has been said on earnings calls for the companies in the S&P 500 over the past 3 months. Irrespective of sector, whether we're talking about industrials, healthcare, financials, energy, doesn't matter. They're all represented on this bar on the far right. So 160 mentions on average over the rolling 3-month period across all of these companies' calls talking about tariffs and the effect they may have on the economy and the stock market. Almost at double the rate from just the prior 3 months, so before the election. And you can see how little people were talking about tariffs over the prior few years. The last time we saw people talking about tariffs this much was the last time President Trump was President Trump. And so it's just interesting to note how much this particular topic is dominating the conversation, not just in headlines on the news, but internally amongst the thought leaders and decision makers at the biggest companies in the United States. And one of the reasons I'm sorry to interrupt, but one of the reasons it's such a dominant topic is because if you look under the hood, if you look at what tariffs do to the economy, it's not just a negative for foreign producers of goods and services who may want to be selling into the U.S. market. It's also bad for the U.S. consumer because at the end of the day, high tariffs mean higher prices. And like so many other economic factors, though, it's the change. When tariffs go up, prices go up. If tariffs stay the same, I mean, the presence of tariffs, we have a lot of tariffs right now. The presence of tariffs by itself is kind of a stable factor now. But when they change, especially if they go up, then the expectation is the prices will go up, which has an impact on inflation. And when prices go up, consumers buy less. So this is something that
impacts both domestic consumers and foreign goods producers. And so it's not at all, from that perspective, it's not at all surprising that it's dominating these earnings calls in recent months.
And
Especially
David,
given,
just to
Yeah,
chime
go
in
ahead,
there, we've
Lauren.
got a couple, I think, really great related questions, but one, just exactly what you were talking about, Dave. The next step of that is we have some people wondering, so how might that impact the portfolios and the investments that everyone has?
Yeah, and
You know,
we'll talk about that.
Yeah.
Oh, go ahead, Dave. No,
Well, I was just going to say,
it.
you know, if you look at the long run, there's been a lot of economic research, as you might imagine, around the impact of inflation on stock prices. And what the evidence has shown over long periods of time is that stock returns tend to impound the impact of inflation. So, you know, when you look at prices, companies pass prices along. Higher prices can reduce demand, which can have a negative impact on companies. But after the initial shock, companies tend to recover, and their prices tend to rise in line with the growth in the economy. So that it's what I was saying a moment ago. It's the change that has the impact. If tariffs remain the same, no matter how high they are right now, then it's almost like it's all priced in. It's the change. So what we worry about, if we're going to worry about anything, is higher tariffs changing, and the short-term impact of that. Over the long run, though, tariffs, higher prices, higher inflation, they tend to get impounded into stock returns. And so you end up getting what's known as a real return, independently of inflation, that's pretty stable over time. But not during those brief periods of change. So that's the key we're looking at is the change.
And the reason it's so perfect what you're highlighting, Dave, because the present guidance from the Oval Office is that tariffs on, China, Mexico, and Canada may be coming as soon as Saturday, February 1st. And so what this particular chart is showing you, this is, if you add up the percentages for all of these bars, it adds up to 100% of the items that were imported into the US in 2023. China being represented here by the lavender color, Chinese goods, and each of these bars, Mexican goods indicated by the red area, and then Canadian goods indicated by maybe the mauve color, if we can use that, on each of these bars. So, Dave, you talked about inflation. When you slap a tariff on an import, it just makes it more expensive. Okay? Capital goods are goods that companies buy to produce consumer goods, which are goods that people buy. If the prices of capital goods being imported from China, Mexico, and Canada go up somewhere between 25 and 50%, as is currently being indicated by the Oval Office, that may impact then the price of consumer goods. Industrial supplies are used to make capital and consumer goods. Those prices go up, everything else gets more expensive. And then autos, agriculture, et cetera. So the point being, tariffs just make things more expensive. And if tariffs are driving prices up, that could be instructive when we think about inflation and where that might be going. So it's dominating because it's news that's current. Go ahead, Dave.
And I'm just going to say, Ray, the earlier question, you can't really time the market on tariffs. It's one of those things where like so many other economic factors, the best way to ride this out is to be broadly diversified. And you know, at the end of the day, that's what we're always doing, is we're looking at how do we build resilience. You know, you cannot be nimble enough to dodge the impact of anything, including tariffs. And so we think in terms of, well, then how do we ride it out? And the way to ride it out is to build resilience. And the best way to build resilience in a stock portfolio or a stock and bond portfolio is to be broadly, globally diversified. You know, to have 12 or 13,000 stocks effectively represented in the portfolio, as is the case with ours, so that the impact on any given company or any given industry or any given country is kind of swamped by the bigger impact across the globe. And so this is just, again, to that earlier question, this is how we prepare for that, and that's how we write it out. It's through resilience, not through timing.
Yeah, and to that point, I mean, we can reference what was happening in markets just a few days ago with the NVIDIA news and NVIDIA being down 15, 20%. The NASDAQ 100 companies listed therein lost $1 trillion of value in a day. And our portfolio was fine. Why? Because we're invested much more broadly than in just one sector or one country. We're everywhere. And so to your point, Dave, maintaining that resilience, I think, is a chief focus when we're thinking about how to position our clients' assets.
And I'll just chime in with one more piece. I think what you both just shared answers a question we had and a comment that markets don't like uncertainty. And given that the current administration is characterized by chaos that is causing this uncertainty, I think the answer that you both were just sharing about the resilience in writing it out is really important here, and what our fundamental beliefs are.
Yeah, stay disciplined, remain diversified, take things one step at a time. Absolutely. Continuing with, again, policy considerations, now focusing on immigration and how some of the things that we've been hearing coming out of the White House could ultimately affect the economy and how those effects might end up showing up in market performance. We've heard a lot about big sweeping changes to immigration policy, things like mass deportation, et cetera. We have yet to see those things come to pass. But if we think about the potential impact, where something like deporting 20 million undocumented individuals from the U.S., what that might do to various industries. This particular chart is showing you the percentage of non-citizen employees across, I think, 15 different industries. So you have landscaping, building services, crop production, construction, and so on. Those leading the way, anywhere between almost 30% and 20% of the folks working in those industries being non-citizens. So if we were to see mass deportation come to pass, what that would lead to is fairly significant job dislocation. And we want to point out.
By the way, I think it's important to note on this chart, it's not saying that 25% of the construction industry are illegal or is manned by illegal aliens. It's just
right.
Non-U.S. citizens, some of whom may be undocumented, but not. This is not saying they all are.
Certainly not. If, however, that policy were to be enacted or executed, the unemployment rate right now is hovering around 4%. We're at full employment as defined by the Fed. As long as unemployment is at 4%, the Fed is happy. To the extent that we have significant job dislocation, this number comes up. If this number comes up, then it may put upward pressure on payrolls, because if there are fewer employees for companies to hire, then they have to compete for a smaller pool in the labor force, and that can drive wages up, that competition amongst companies for fewer employees. When wages are going up or wages are growing at a higher rate like they were in 2022, that can have upward pressure on inflation. And so we just note these things as considerations that we're paying attention to because they're going to inform, we think, how things unfold. And so we'll be watching these types of indicators as the weeks and months go by. And certainly we'll be watching, the Fed to see what decisions they make as they are continuing to see what the labor market is doing, what inflation is doing, and then having the rest of their meetings throughout the first half of this year. We've highlighted those dates here. Presently, they've decided to keep interest rates where they are. Presently, the economy is humming along. Dave, as you said, it's performing really well. And we'll see how, as things unfold, we'll see if that changes. And if things change, we'll be on top of it. And certainly reporting back to you all about the things that we're thinking about as we continue on down the road here in 2025.
And now,
So, yes, exactly. We're going to pivot to a more focused conversation about financial planning topics. But before we do that, we wanted to check back in. So we asked you at the top, how are you feeling? Now that you've heard from us for some 45 minutes, have we moved the needle? And if so, hopefully in a positive direction.
is outro the opposite of intro? Is that what that is?
There's more,
Certainly still an array of responses. Yeah, go ahead, Lauren.
almost 4x the calm responses than our
Good.
initial poll so far.
Oh, you know what? Our
Take
friend
it.
Tom is saying that outro is actually a musical term. How interesting.
Well, again, thank you all for engaging. Lauren, you going to share the results?
Yep,
Perfect.
here we are.
Thank you all for engaging. And with that, I'm going to be quiet and pivot over to Lauren, who's going to take us on a tour of a couple of our other slides here.
Absolutely. And so one of the things that I often am the one to swoop in and share is that certainly we talk a lot about markets, economy, because it really matters to people. We are obviously having a lot of questions on all of these topics all the time in all of our meetings, emails. It's what we all see constantly if we are attached to the news in any way, shape, or form. And I also know there are some people on this call who have detached from the news, and I think that can also be really healthy for mental health. And we think of ourselves really first and foremost as financial planners, and that covers every aspect of your life, including your investments and what's happening in the world and how you're perceiving it and what we need to be planning for. And so as Yusuf was sharing at the end of his piece there, to the extent that there are things you need to know about and act on, you will hear from us. I can confidently say that these two gentlemen are very attached to the news and what's happening in markets and paying attention and thinking about you all the time in what's going on. And similarly, I am in the same place with respect to taxes, estate planning, required minimum distributions, tax law changes, all the things that are coming that have happened over the past few years. I definitely have put my master's degree to work in writing all of our articles about all the tax law changes since 2017. And so I just wanted to share some things that have been on my mind, some things that have changed recently, some other pieces just to remind of all the various planning aspects that we're thinking about. And so starting off first with inherited IRAs, there are some finally clarified regulations from the IRS. And really, we think about inherited IRAs right now kind of in three buckets. If you have an inherited IRA that you inherited prior to January 1, 2020, that inherited IRA is on the old rules, and you are taking required minimum distributions from that account based on your life expectancy. That's called the stretch. Now, after January 1, 2020, for a while, it was called the death of the stretch. There are only a few people left allowed or privileged with that opportunity to stretch these distributions out over their remaining life expectancy. So for the first bucket is pre-January 1, 2020, and then there are two post-January 1, 2020 buckets. All of the inherited IRAs after January 1, 2020, or most of them, are subject to the 10-year rule. So unless you are a spouse or you have another special beneficiary status, you have to take the full amount of that inherited IRA out within 10 years after the passing of the original IRA owner. And some of those IRAs starting this year will also be subject to required minimum distributions. So if the person who originally owned the inherited IRA was taking required minimum distributions before they passed away, you will now also have required minimum distributions based on the longer of your life expectancy or the decedent's life expectancy. So all of that long-winded explanation to say, if that applies to you, you have heard from us or will hear from us soon on what that required minimum distribution amount will be, setting up the logistics to get it distributed to you, doing the tax planning so that you know what those taxes will be on that amount, and also talking about that 10-year plan. What's going to make the most sense for you for getting all the funds out of that inherited IRA within that 10-year period, and doing long-term tax analysis. Also, required minimum distributions, the age has changed a lot over the last few years. You may have the number 70.5 in your mind. That is what the required beginning date for required minimum distributions was previously. It was then bumped up to 72 and then again further bumped up to 73. So the current start date, if you have not started RMDs, is the year you turn 73. It then later will shift to 75. So anyone born in 1960 or later, your required beginning date for required minimum distributions is the year you turn 75. And so again, this is something we have extensive reports from Schwab with all of the accounts that we manage, who's subject to RMDs, what is the amount. And if it's your first year, we'll be reaching out. If we haven't already talked about it in a recent meeting, we'll be reaching out to make sure we're planning for that with you in getting the actual distribution set up, how you want it, timing, planning for the taxes. So just something that is big on our minds and the financial planning team right now because it's the beginning of the year. And so we're thinking about all of these things that have to happen by the end of the year, because although it is only the end of January, as Elisa always says, we will be planning Thanksgiving dinner momentarily. On that note, something I didn't add in here, but just something that is also really we're working on as a team right now is for all of our spending clients. So for those of you who are spending from your portfolio, you either have heard from us very recently or will be hearing from us in the coming days about what 2024 looked like, what your spending target was, what your spending target is for 2025. And the team is busy at work rebalancing and raising cash for those spending clients in those accounts. So you'll hear lots from us if you haven't already on those various action steps that we're taking to support you in your spending. There are a couple other changes that have come about in recent tax law changes. So the Secure Act 2.0 is where some of these changes happened. Another one that was just top of mind that I haven't talked a lot about recently, but popped into my head with a client in an article I was reading the other day is that for Roth IRAs, so Roth IRAs are accounts where you have contributed after-tax dollars and they grow tax-free forever. Roth IRAs do not have required minimum distributions like IRAs do. However, Roth 401ks or 403bs or 457s, if you had those through your employer, were previously subject to required minimum distributions. Not taxed, but they required you to take the money out and stop that tax-deferred growth. That has changed. With the most recent tax law change, there are no longer required minimum distributions from those Roth employer accounts, which is a great benefit. And the final piece here is just another one of these recent changes for any of you out there who are thinking about starting a business, or you have recently started a business and you are planning to have certain level of employees, or you have a certain level of employees. I believe it's over 10 employees. It's now required that new 401k plans that companies are starting for their employees, for their firms that have that larger number of employees, have automatic enrollment for employees. And part of this is in thinking about setting up our country for more retirement savings. And it's a behavioral finance thing that's being put into action. If you are automatically opted into something, you're a lot less likely to opt yourself out than you are to opt yourself in if it's not an automatic enrollment. And so it's similar to, I know there was research done, it's like being an organ donor. It happens a lot less frequently if you have to opt into it than if it's an automatic and you have to opt out. And so the
so-called status quo bias.
Yes.
Defaults are really powerful.
Absolutely. And so that automatic enrollment it has to be between 3 and 10%, increasing 1% per year until it gets to at least 10%. By the way, this is not forced. You can opt out of this if you happen to work for one of these companies, or if you are an employer starting a 401k plan and have to give this to your employees, they can still, of course, opt out and change the amount. We have a question here about, are stretch IRAs still allowed? And so the stretch, if we go back to the top bullet, if you inherited an IRA prior to January 1, 2020, and you have been stretching, that remains the same. Those are all grandfathered in, nothing changes. You will still continue to have those required minimum distributions every year based on your life expectancy. Those are amounts that we calculate and make sure are taken care of throughout the year based on your desires, whether it's as a chunk or coming out over time. And there are some special rules in there. I have an article, Yusuf is going to do a post answering all of these questions. We'll link to some of the articles about these tax law changes. There are a few special categories of people who can still stretch those required minimum distributions out. An obvious one being spouses. Spouses can take those IRAs and treat them as their own, which means they get to stretch those required minimum distributions out through their lifetime, and a few others. So we'll link to that in the responses when we create an article about these questions. And so, sorry, one more here, just on that inherited
Oh,
IRA piece
sorry.
I was reading. So if our children inherit our IRAs that we are currently drawing from, do they get their inheritance at the same amount and cadence as our withdrawals at the time of death? The required answer is no. They would inherit and they would be taking required minimum distributions. The amount would be dictated by their life expectancy, because their life expectancy is longer than yours. You are older than them, and they would have the required 10-year period. However, those are minimums. There isn't a maximum. And so if they needed the funds, or from a tax perspective, they have really low tax rates in certain years, they can take more than the required minimum distribution amount out in any year. So the next piece on the next slide here, just talking about contribution limits. These are updated every year. The IRS determines what the updated contribution limits are. Most of them at this point are indexed for inflation. And so as inflation happens, these contribution amounts go up every year. Right now, the base maximum IRA contribution limit for 2025 is $7,000. If you will be over 50 at the end of this year, you qualify for the catch-up contribution, which is an additional $1,000. So $8,000 maximum to an IRA. There are income limitations there on whether you can deduct those IRA contributions on your tax return or not. And that is true of IRAs, and it's also true of your ability or your qualification to be able to contribute directly to a Roth IRA. So Roth IRAs have the same annual contribution limits, different income limits on whether or not you can contribute to a Roth IRA. And for 401ks and similar employer plans, so that would also include 403bs, 457s, the maximum annual contribution in 2025 is $23,500. Now, here's where one of these unique law changes comes in. If you are over the age of 50, but under the age of 60, your catch-up contribution for 2025 is $7,500. So you can put in $31,000 of total contributions to your employer retirement account in 2025. However, there's this supercharged catch-up contribution for those who are going to be ages 60 to 63 as of December 31 this year. And that's $11,250 this year. So those who are between 60 and 63 as of December 31, 2025 can contribute a total of $34,750 this year to those employer retirement accounts. One of the interesting pieces that is coming next year, it was supposed to start in 2024. The IRS, as they often do, kind of waited pretty late to give guidance and then said, we'll give you 2 years to figure this out logistically. Starting next year, if you earn more than $145,000 in the year and you are making catch-up contributions, they will be required to go into a Roth account. So that means a couple things. First, the employers have to have the ability for a Roth account to be funded. That's one of the logistical pieces the IRS is giving time for, is for all of these employers to amend their actual 401k summary plan descriptions to allow for Roth contributions, and then work with the custodians to figure out how they're going to set up these Roth accounts and track them. The other piece that means is that for those earning more than $145,000 a year and doing these catch-up contributions, that will become taxable income, because when you do a Roth contribution, you have to pay tax on it first, and then you can contribute that amount. And just a question here, if high earners can contribute to an employer 401k Roth after tax? Yes. So if your employer allows Roth contributions in any fashion, you can choose to do some or all of your other contributions as Roth as well. It's just that if you also do the catch up, it will, starting next year, will be required to go into the Roth portion of the account. So shifting gears a little bit, still tax related here, but circling back to some of the questions and some of the things we were talking about Trump's presidency administration and the things that he has talked about. If some of these tax promises come true that he talked about, certainly on the campaign trail, but has talked about a bit more now, this is just showing here what would the actual cost of those changes be. So one of the things that I am the one thinking about all the time and paying attention to is what's going to happen at the end of this year, because end of 2025, currently Trump's 2017 Tax Cut and Jobs Act, the TCJA, is set to sunset. So if you live in California, that's what initiated the $10,000 state and local income tax itemized deduction limitation on your tax return. It reduced tax rates. There are some other pieces there that are set to sunset, including the estate tax exemption, setting to sunset back to half of its current value. Right now, again, we don't make predictions, but what I am reading, what we're reading, it looks like the most likely is what Trump and his team are hoping for is to extend the Tax Cut and Jobs Act without significant changes, because they're feeling like that might be the path of least resistance since it's something that's already in place. But it would cost $5.3 trillion to do that compared to if it does actually sunset. Similarly, Trump has talked about no tax on overtime income, Social Security benefits, tips. All of those pieces have a cost to them. And as we've heard and certainly have been talking about, he also has made promises about reducing the deficit, cutting spending. All three of those things obviously play together. And so if some of these things actually go through, he's going to have to make changes elsewhere in order to make it all work. The other piece there in the bottom right corner is lower corporate tax rates for domestic manufacturers, and then new tax credits for first-time home buyers. So the reason each of those squares in this image is relative to their size. So the 2017 tax cuts being the most expensive of these potential tax promises. And this is another one I will be paying attention. When there is news, you will hear from us on a webinar, in articles. If there is action that you specifically need to take or that any of our clients need to take for their situation, we'll reach out. And now for tax season, it's hard to imagine it's actually here already. And I know if we have, I think I saw at least one of our tax professionals here on the webinar, probably thick in the season of getting everything going for tax day. So talking about filing 2024 taxes, the IRS just started accepting 2024 tax returns on Monday. And so that officially means tax season is underway, although I know our CPAs, EAs, and tax professionals have been in the mode for longer than that. With respect to your Schwab accounts, there are some tax forms, and you will also see this summarized in the Live Big Way digest that will go out tomorrow morning with a link of showing you where you can find everything on Schwab. So Form 1099-R, that's for retirement accounts where you took distributions in 2024. Those are available now on Schwab. The 1099 for your taxable accounts, so that's going to be trust accounts, brokerage accounts, those will be available starting by February 14th, and corrections starting February 28th. A big thing here, don't wait to meet with your tax professional for these deadlines. You can share these documents with them after they're available. They're busy. Everything you can get to them sooner rather than later is really helpful to them. So there's no need to wait for your meeting for those documents. You can share them as soon as they're available. And then the final piece I just wanted to share here was that the IRS and the California Franchise Tax Board extended deadlines for those affected by the LA fires. So anyone in a FEMA designated disaster area code can now delay all payments and filing until October 15th of this year. This is another one. I know there are people who have been significantly affected, and this is going to be very helpful for them. If you happen to be in one of these zip codes, but you weren't affected, you have your documents, you're able to get things to them, there's no need to delay for that reason either. Get things going. The sooner you get things moving, the better for everyone. Just gives you more time to get everything done on time. And for once, I think I was the one who took us over time instead of Dave and Yusuf, and that is impressive.
We'll take at least part of the blame for that, Lauren.
As always. Thank you for spending your time with us. This has been recorded, so if you want to see it again, or for that matter, if you'd like to share it with friends or colleagues or family members, you'll be getting a link to this. And as both Lauren and Yusuf have said repeatedly, we are always available to answer follow-up questions. Call us, email us, whatever. We'll make sure that you get the answers you need. So thank you very much. I hope the rest of your Thursday is wonderful, and we'll look forward to seeing you again soon.
Take care.
Thank you.